Welcome to the first core perspective of the year, where I am in conversation with Dr. Yanni Leach this morning. And the reason why I'm here is one of the things we've been talking about and wanting to share is really how do we move beyond some of the limiting narratives we have around how we talk around passive, and how do we take a wider lens. And part of taking that wider lens is looking at some of the really interesting stuff that's been coming up in behavioral science, but also looking at some of the market dynamics, the actual function of what markets do, where passive fits in, where active fits in, and really trying to broaden this debate. And when we look at in the last few years, one of the books we've talked about already in a previous conversation around core was Noise. And Noise is really looking at decision making in a context of uncertainty, which is pretty much what we have in investing, and how we improve that and what that looks like. And the other side of something that's really been very interesting and topical that's come out of the academic domain into the public domain is this idea of narrative, really popularized in narrative economics by Robert Shiller, and really looking at how narrative can play a role in how we construct reality and when it can become limiting. And one of those limiting narratives that we've seen in the passive space is really limiting ourselves to really quantitative, relatively narrow analyses where we talk about passive versus active or passive blending with active, but really not widening the lens and seeing all the other interesting dynamics happening in the market today. So I'm really excited to be here today with Yanni and really to kick off at looking at how do we widen the lens? What's a better narrative than the one we're looking at the moment?
Thank you, Amy. So I think the best place to start is to actually have a look at how those narratives have evolved and why. So, I mean, when I initially joined the industry, I got quite a lot of pushback from intermediaries in the sense that they saw passive as a threat. They also saw that it, or feared that it may lead to disintermediation. And a lot of that, of course, stemmed that a number of the first passive providers in South Africa were very anti-active and were also very anti-financial advisors. And I think so that negative reaction was partly due to those factors. The other factor, of course, was that advisors were afraid that if they can't get higher returns, they won't be able to provide good outcomes for the investors, and so we're hoping that they could get higher returns from active managers. Now, what we've seen over the past decade, we've sort of seen that narrative evolve towards an active and passive debate, and I think it's partly because of regulation, transparency in terms of fees and of performance, having actual passive funds that could be used within financial plans that had built up sufficient track records for financial advisors to get comfortable. And then, of course, the big shift what we've seen with the changes in the phase and RDR kind of regulation, where increasingly advisors have started using DFMs. And I think DFMs have probably been some of the biggest important role players and shifting the narrative from the active versus passive to including some passive within an investment portfolio. Now, where we are now is almost like the next conversation is to actually start looking at the far bigger picture and trying to understand really what is sitting behind this shift towards passive investing. And I think that the first step in that conversation is to begin to understand how high levels of competition changes market dynamics. And then we'll start having a look at how we unpack the drivers behind passive. And in our next presentation, we'll look at how that impacts fund selection. So in this presentation, I'm going to focus a lot on the drivers behind passive and sort of highlight some of the behavioral or noise elements within that process for individuals to sort of understand the big picture a little bit better. Now, as a starting point, I think it's really important to understand that when we talk about the market portfolio, we are not talking just about equities. We are talking about all investable assets. There were some really good papers recently that sort of have actually started quantifying and sort of like showing what the investable universe is. And so you can sort of like see there on the left-hand side, it's about half in growth assets across equities, private equity, and real estate, and half of the investable universe is in fixed income. And on the right, you can see how those weightings have actually changed in time. They haven't been static. I mean, largely driven by governments issuing debt, you can see in the 70s, and then after the financial crisis. But I think the important point is that when we talk about the market portfolio, you look at all of the investment opportunities, not just equities. The second important point as a starting point for the conversation is to understand that it's not just the active asset management community that is involved in price discovery. In fact, when you look at regulated funds that are managed by asset managers, it only really makes up 26% of all investable assets. The remainder of the assets are managed by banks, sovereign central banks, sovereign wealth funds, insurance companies, hedge funds, etc. And so there's quite a number of other participants that participates in the price discovery process. The only real benefit, and I think why we sort of like going to focus on the asset management side, is because we have funds where there are clear transparency in terms of performance. We've had an evolved industry where there are clear categories so that you can compare relative performances, etc. It is the one space where we can actually go and measure the long-term impact of competition within the price discovery and markets for that matter. And that's why we're going to focus on that sliver, that 26% of investable assets. Now, Charles Ellis was famous. He wrote the book, Winning the Loser's Game. And in there, he sort of already started illustrating that the increased skills within the asset management community is slowly but surely reducing the opportunity set, so to speak. So, and I mean, the best way that I sometimes think of explaining it is if you think of the 100-meter Olympic competition at the Olympic Games. If you look at the heats, the fastest runner is typically about a second faster than the slowest runner in the heats. If you look at the average time, it's sitting at about 10 seconds. When you move to the semifinals, the average time goes from 10 to about just under 9.9 seconds. But the relative performance between the fastest and the slower reduces to 0.4. So you see an absolute improvement in skills, but you see a narrowing in relative skills. And so when you get to the final, it's even worse. The average time is sitting at about 9.8 with a difference in times of only 0.25 seconds. So as the competition gets this tougher and the weaker player falls away, you get better overall outcomes, but it's more difficult to compete relative to your competitors. And I mean, to some extent, you can see that on the right-hand side, where we've compared that reduction in outperformance with the total expense ratios of funds 5 years later. And you can see there's almost like a perfect correlation. And a lot of that has been the adoption of passive. It's really been passive that's been driving down the expense ratio, not really a reduction in active fund management fees. But basically, you can see that sort of like adoption is linked to the narrowing of relative performance. And so it's a good time to sort of like have a look at what were the main drivers behind this shift, this reduction in opportunity set or the toughening of competition. And there are broadly 4 main drivers. The very first one is regulation, and quite importantly, the regulation in terms of corporate disclosure. Through that regulation, the playing fields were level, so no specific market participant had an advantage over another one, and so you could get fair movement in terms of price discovery, information, etc. The second part of the conversation is the market environment. So we have seen a lower return environment over the long term. So generally, the case for passive over the long term, over longer term periods of, let's say, 10 or 20 years have always been clear because your relative performance over the long term narrows. And that's because a lot of the noise ends up getting taken out of the market. And so then you're basically just having a look at the long term impact of various strategies. But by having a lower returns in the short term, one could see those differences coming through in terms of active versus passive funds. And I think that's put a lot more emphasis on the adoption of passive. The third driver is perhaps the biggest driver, which is technology. It's really like the internet and the ability to communicate information very quickly that has sort of like changed the ball game largely. It means that it doesn't matter where you sit in the world, you can get access to the latest corporate financial results from a company around about at the same time as what any other role player in the world can get. Of course, things like the computing power and cost in terms of doing a lot of analytical work, risk work, etc. And of course, that implication on trading efficiency and trading costs. Because in the early days of index funds in the 70s, transaction costs were really high and index funds weren't actually that competitive. But through this like continuous improvement of technology, lowering of transaction costs, index funds have become far more compelling than what they were 40 years ago. And then the last point is the point that I just illustrated through the example of that Olympic competition, which is there are more informed investors than there were in the past. And so it is really informed investors playing against other informed investors. So there are fewer people making mistakes or making uninformed decisions within the market, which means that the game is getting continuously stronger. The net effect is that effectively you are beginning to aggregate all those experts' views into the market. And from that point of view, the market represents all active. It's basically giving you the aggregated views of all active market participants. And that occurs at two levels. The first level is at the underlying fund managers that are allocating to the market and deciding how much they're going to allocate to different shares, etc. But the second level of noise reduction, if you want, has sort of happened in the fund allocator space. So as fund selectors have done their work, they've identified a new fund manager that they think have sufficient skill, they've allocated more asset to that manager. Because that manager manages more assets, they can allocate more to the markets, and the impact they have on the market in terms of price discovery gets bigger and bigger. Even though the yield or the outperformance percentage may decrease in time, the amount of inefficiencies that they can take out of the market has increased in Dan terms. And that really, Amy, is I think a lot of the work that you've been doing on noise sort of like comes in terms of how it can reduce the mistakes that experts make.
Absolutely, and I think that's what I find so interesting about looking at passive through this lens, because you have these kind of two layers going on. And so if we think about, when we talk about noise, what are we talking about? So these experts are making decisions around price discovery, and there is a part of that that is super valuable and super necessary, and we absolutely want. But there's a part of that that is not being driven by the expertise. It's these different types of mistakes, which can vary from, just someone having their own implicit preference for certain types of markets and certain types of shares, or it could be what they had for breakfast. Now, these are the kinds of things we don't want in the market. And so what we get with aggregation is you start refining and really getting that pure expertise and stripping out some of this noise, which is the piece we don't want. And what I find so interesting about what you just said is it's happening on two levels when you're using this kind of this rules-based passive style approach, because you've got one level of experts who are picking shares and instruments and debt instruments, and so you are aggregating them, and so you're stripping out noise. But then you've got the second layer of skill, which is the expertise around which price discovery managers, who's good at it and who's bad at it, where is the skill sitting. So it's a second layer of judgment where we're also getting the noise reduced because of the fact that we're looking at asset weighted returns. So you're actually getting noise reduction in two forms and getting the skills of two layers of market participants really refined down and stripping out the bits that are just noise.
Yeah, and I think the challenge, however, for these market participants is that because it's been such a lucrative game, it's attracted so many different people to the investment and financial services in general. I mean, if I just sort of think of the research group that I was part of as part of my PhD, of the PhDs and postdocs that were part of that research group at that particular time, more than half of us have ended up in financial services. And I think this is really where the challenge comes in, is that there is currently more than 1 million core investment professionals worldwide. And so the challenge for individual players becomes now, it's like, well, how do they add value when there is such a large pool of skilled people producing these results? It becomes very difficult for each individual player to go and specifically go and quantify their specific value add. And I think this is really where the challenge is that we've almost gotten what you called a saturation of specialized skills. Simply put, there are just too many people trying to do the same thing. And I think that's really where we are at the moment. And that's why passive then becomes almost a mechanism by which you start weeding out the redundancy in that way.
So we've got all the skill moving into the market and raising the amount of skill available in the market, but this is creating this kind of oversaturation of expertise. And then what passive is doing is allowing us to ideally be extracting the best of that and stripping out the noise aspects. I mean, if I think about that mathematically, my sense would be that that would be very supportive of performance for passive, particularly over the longer terms. Is that what we're seeing?
Yes, I mean, we can basically see it in our own core ranges performance as well. I mean, the funds with the longer term track records have definitely got better relative performance versus their peers. I mean, and we've seen those sort of like relative rankings improved almost continuously as the funds have built up longer term track records. And now, I mean, our two oldest funds, our core diversified and our core guarded funds, are really sitting among the top 3 or 4 funds in a given category. So there aren't many active funds that would have produced higher returns. I think at this point in time, it's actually quite good to unpack that a little bit and sort of like illustrate how that aggregation of markets and aggregations of fund allocators actually filters through into the relative advantage that market style portfolios have versus the broader active funds in their category. Now, one of the big misnomers is that people usually talk about that the average fund manager will deliver the same return as the market, less fees. But that's sort of thinking about fund managers having equal amounts of assets in the market, which is definitely not the case, as we've illustrated in the slides before. The reality is that you need to look at the asset-weighted returns of categories to get an idea of how this sort of like allocation towards underlying funds has an impact on the outcome. Now, what you can clearly see on the slide on the left is, in fact, you can see that the funds that have delivered better returns over the long term have actually received more assets, because the asset weighted return is about 0.5% higher per annum than the equally weighted return. And so there's some of that market dynamics, that allocation of towards experts that's sort of playing itself out. And you can see in that space about 70% of the assets sits in the 10 largest funds. And that is basically almost in every single category across the board. And so the test of the theory to some extent is to see whether a similarly or a well-constructed benchmark passive fund would deliver the same returns before fees as that asset-weighted return. And we did that exercise last year for all of the major categories, and we found that that broadly was the case. On the right-hand side, we've illustrated that by looking at the largest category in South Africa, which is the multi-asset, and where you can see that the gross of fee returns of the market style portfolio, the core diversified, was very similar to what the peer-weighted average. In fact, once you accounted for the risk-adjusted returns would be in the vicinity of about 11.8, which is very, very, very close. And so broadly what you're getting is that you're getting that aggregated view, same returns, but then once you now account for fees, you're getting it at a much lower cost. And that's the reason why over time, these kind of funds end up doing really well versus the active peers, because they are aggregating all that information. They're giving you that market portfolio, but then at a reduced cost. And that, of course, presents a challenge to market participants. I mean, what we're seeing effectively is that we are continuously working in this industry where we have diminishing marginal gains. So going forward, it becomes more and more difficult to illustrate value add. And I mean, we've illustrated this in the slide where we looked at the largest 10 funds where most of the assets are within the multi-asset space, and then looked at the performances of, had you picked the best performing fund 12 years ago, had you picked the best 4 performing funds, to see how those kind of returns would stack up versus a market style portfolio. And as you can see, I mean, the best performing fund would have outperformed by about 0.1, 0.2%. If you go and have a look at the list fee classes, which of course there's a bigger reduction in active fees than there is compared to passive funds, then that sort of a number goes up to about 11.6. In other words, then the difference is about 0.4%. But when you look at selecting the top 4 funds and then holding them for the whole period, there's not really a lot of benefit. And I mean, in very few cases are managers actually able to actually hold onto funds. Quite often what happens is the age-old investor behavior penalty is that investors switch out of poor performing funds and into better performing funds. And so what this illustrates is that the amount of gains on the table has gotten less and less. And so that there is, for any fund selector, there is significantly more downside than there is upside. And I think that's the challenge that we have to sort of like deal with going forward. And I think in many cases, intermediaries will have to start rethinking their value add, where traditionally it was very much based around investments, rather than some of the other fields of financial investments. Now, as a consequence of this sort of like diminishing marginal gains, we've seen massive adoption of passive strategies. And we have a look at sort of a comparison between the South African market and the US market. I mean, in the SA market, we're only sitting with just under 6% in passive funds, compared to the US, where it's now sitting at 40%. And then among advisors, the average advisor in South Africa has only got about 5% in passive. With DFMs, you can see that trend, it's increasing, and it's sort of like tending to where the average allocation in a DFM portfolio is of about 18%. But if you compare that to the US, where you can see now that most advisors have over 60% in passive in the equities and approaching 40% in their fixed income space, and it is continuously increasing. So this trend, I think, will continue as the game gets tougher and tougher, and those sort of like relative returns, that dispersions, continuously decreases. Now, Amy, the impact, of course, quite a lot of people quite often ask me, but where would this end? I mean, if the whole market is passive, then where would we get price discovery, etc. from? And I think, I suppose this sort of like takes us back to that original slide, is that asset managers are not the only people involved in price discovery.
Yeah, and I think that's it's really important that I mean, it's always sobering for me when I see those statistics. It's like you sort of know it, but then you go look at the statistic and it's even more than you think, that it really is only 26% of the market, even when you're looking at this whole slice of the pie. And you've got all these other role players, and they're looking at price discovery, but they're also looking at price discovery from such a range of perspectives. I mean, I remember in my investment banking days, and now it's not allowed, but you would have, the algo traders, and, they're looking for all the arbitrage opportunities. Now, mostly that's done by hedge funds. You've got the guys who are looking for that, they're cleaning up price discovery on the very, very short term end. But then you've also got the sovereign wealth funds and the liability-driven investors who are looking at price discovery through a really long time frame, and so they're doing a price discovery from a very different time frame. And I think that creates such an interesting dynamic, is that price discovery is not just about the people who are playing to answer the particular question we're looking at today. There is actually so much else going on in price discovery at these different time scales.
Exactly. And I mean, I think for that reason, we can expect that passive will become an even bigger player, even in the US, where one would sort of think 40% is already a high number. And I mean, it takes us back to the whole conversation around redundancy of just having too many people doing the same thing. That there's going to be less and less room for people that can't really go and illustrate that they're adding value in the system.
Yeah, and I thought that slide, the microeconomist in me sort of gets excited when I see that gap between the best performing and the worst performing, and it's quite wide. To your illustration earlier around when you look at the heats in the Olympics, it's quite a wide range. And the interesting dynamic of passive, where it's kind of this low cost, high quality alternative, and what that does is it improves the market, the competitive dynamics in the market, so that you lose the people the experts that are not as good at price discovery and are not as good at the various parts of the value chain, and that should refine each element of the value chain, so you're getting better and better experts remaining in each portion. And then again, if I understand, that would then reinforce passive as well, because passive is again aggregating across stronger and stronger groups, and our passive is aggregating across the final instead of across the heats.
Exactly. So I mean, to conclude the sort of like a very like holistic take on the whole like passive conversation, I think we've clearly illustrated that well-designed market strategies are able to harness all the skills of asset managers and fund allocators, and that low-cost market funds are able, or basically provide a mechanism to ensure that only role players that really add value can stay in the game and earn a premium for it. And I think quite a good, almost like way of framing our collective goal is that we as an industry need to be part and parcel of a system that reduces the cost that society pays for price discovery and liquidity. And as sort of like, I mean, one of the points, I mean, I have mentioned it a few times, I mean, and I think it's especially applicable now on the SA market. And I mean, Neil Brown said it recently in an interview to Stephen Cranson, that you've got this continuous, highly competitive system that is making it more and more difficult for players to stay in the game. Plus, then you've got the South African market that has shrunk substantially. So, I mean, I think there are a lot of challenges going forward in terms of staying in the game for many asset managers. In our next presentation, we are specifically going to go and unpack the implications that these diminishing marginal gains have for fund selectors and for portfolio construction. Thanks a lot.